Hedge funds, those shadowy, high-powered financial institutions that we hear about but rarely fully understand. When we talk about hedge funds, we're not just talking about some casual investment group. We're talking about some of the biggest players in the global financial ecosystem, the ones who move markets, control billions, and shape economies. But what exactly are they? And how do they manage to make so much money, even when they lose? Let's start with the basics. A hedge fund, in its simplest form, is an investment fund that pools capital from wealthy individuals and institutional investors to invest in a wide array of assets. Sounds pretty basic, right? But these aren't your typical mutual funds or index funds. Hedge funds are designed to make money regardless of what the market does. They're meant to be the market wizards, the ones who can profit in a bull market, a bear market, or any other type of market in between. Unlike traditional investment funds, hedge funds don't just sit back and watch their investments. They actively bet against stocks, buy short positions, use leverage, and even trade derivatives. These are high-risk, high-reward strategies that hedge funds use to generate their massive returns. The key is that hedge funds are actively trying to outsmart the market, often using complex mathematical models, market predictions, and algorithms. But let's not get ahead of ourselves. To understand how hedge funds work, you have to first understand a few things about the people who run them: the managers, the quants, and the traders. These are the guys and girls who live, eat, and breathe numbers. In fact, many hedge fund managers come from backgrounds in math, physics, engineering, and computer science. You have people with PhDs in quantitative analysis, statisticians, computer scientists, all working together to figure out how to beat the market. Now, you might be wondering, how does all of this really work in practice? Well, let's dive into it. First, hedge funds typically employ a strategy known as long-short equity. What does that mean? In simple terms, it means they're buying stocks that they believe will go up in value, while simultaneously betting on stocks they believe will drop in value. This allows them to profit from both rising and falling markets. Let's break it down with a real-world example. Imagine a hedge fund manager believes that Company A is undervalued and Company B is overvalued. The fund buys shares of Company A and shorts shares of Company B. If Company A's stock goes up and Company B's stock goes down, the fund makes money on both sides of the trade. But if they're wrong, well, they lose money on both sides. That's the nature of the game. But hedge funds don't just rely on simple long-short equity strategies. They also use other tactics like leverage and derivatives to maximize their returns. Leverage, for example, is when a hedge fund borrows money to increase the size of their investments. If they're right, they can make massive profits. If they're wrong, well, they can end up losing far more than they invested. Derivatives are another key part of the hedge fund playbook. These are financial contracts whose value is tied to the price of an underlying asset, like stocks, bonds, or commodities. The most common types of derivatives include options, futures, and swaps. Hedge funds use these tools to hedge their risks or to make speculative bets on the price movements of different assets. But let's be real here. Hedge funds don't just sit around all day analyzing data and building models. There's a lot of money involved and a lot of risks. We're talking about billions of dollars on the line. One wrong move can result in massive losses. So, how do hedge funds ensure they can handle that risk? They have a secret weapon: fees. The fee structure in hedge funds is what sets them apart from other investment vehicles. The typical fee arrangement for a hedge fund is called 2 and 20. This means the hedge fund charges a 2% management fee and then takes 20% of the profits. That means even if the fund doesn't do well, they still get paid a percentage of the capital they manage. But if the fund is successful, that 20% cut of profits can be huge. Just think about how much money a hedge fund would make if it manages $1 billion in assets and generates a 20% return. That's $200 million in profits and $40 million for the hedge fund managers, just in fees. This brings us to the question, how do hedge funds make money even when they lose? The answer is simple. They never stop charging fees. Whether they make a profit or not, they take their 2% fee from the assets under management. Let's take a real example. Citadel, one of the largest hedge funds in the world. Citadel manages around $65 billion in assets. With a 2% fee, that means they're making $1.3 billion every year just in management fees. Even if they don't make a single profitable trade, they're still bringing in massive amounts of cash from their clients. But how do they actually trade? What's the secret sauce that allows these hedge funds to outperform the market? Part of it is the use of sophisticated algorithms, machine learning, and artificial intelligence. Hedge funds have entire teams of quants and data scientists who build these complex systems to analyze the markets, predict price movements, and execute trades at lightning speed. These algorithms can spot tiny inefficiencies in the market, such as small price discrepancies or patterns that human traders would miss, and then exploit them in real time. The best example of this is Renaissance Technologies, a hedge fund founded by Jim Simons, one of the most successful mathematicians of all time. Renaissance's Medallion Fund has delivered annual returns of around 66%, more than triple the returns of Warren Buffett's Berkshire Hathaway. This is despite the fact that Medallion has been running for decades and has had to deal with a changing market environment. Simons and his team built an algorithmic trading system that could analyze massive amounts of data, identify profitable patterns, and make trades faster than any human ever could. So, how does this all work in practice? Let's talk about some real-world success stories. One of the most famous hedge fund trades of all time came from George Soros, who made $1 billion in a single day by betting against the British pound. This was in 1992, when Soros noticed that the UK had an agreement with Europe to keep the pound within a fixed exchange rate band against the German Deutsche Mark. But with high inflation and interest rates in the UK, Soros realized the pound was about to fall. He bet billions of dollars that the pound would devalue, and when the UK was forced to break its agreement, Soros made a fortune. This trade has gone down in history as one of the most successful and profitable hedge fund moves ever. But for every hedge fund success story, there's a disaster waiting to happen. Long-term capital management is a prime example of how things can go horribly wrong. LTCM was founded in the 1990s by a group of economists, including 2 Nobel Prize winners, and quickly became one of the most famous hedge funds of its time. They used complex mathematical models to make ultra-safe trades that they believed could never fail. At first, everything seemed great. They were making huge profits and attracting massive investments. But in 1998, everything collapsed. Russia defaulted on its government debt, and LTCM's models couldn't handle the unforeseen market shock. They lost billions of dollars and nearly brought down the global financial system. The Federal Reserve had to step in and bail them out to prevent a complete collapse. So, what can we learn from these stories? Hedge funds are a double-edged sword. On the one hand, they can make billions by exploiting market inefficiencies, using advanced technology, and betting on big-picture trends. But on the other hand, they're incredibly risky. The failure of LTCM shows just how dangerous leverage, high-stakes betting, and reliance on mathematical models can be. In a world of hedge funds, one mistake can result in billions of dollars in losses, and not just for the fund, but for the entire financial system. But what does the future hold for hedge funds? The rise of AI and machine learning is already revolutionizing the way hedge funds trade. We're seeing more and more hedge funds turn to artificial intelligence to predict market trends, optimize their trading strategies, and automate their operations. This has the potential to create a new breed of hedge funds that are even faster, more efficient, and more profitable than ever before. But with greater power comes greater risk. If AI systems make the wrong predictions or face unexpected market shocks, the consequences could be catastrophic. In conclusion, hedge funds are some of the most powerful and influential financial institutions in the world. They've been responsible for some of the most successful trades in history, but they've also faced their fair share of failures. As the industry continues to evolve, hedge funds will play an even bigger role in shaping the global financial landscape. But only time will tell if they'll continue to deliver the outsized returns they're known for, or if they'll ultimately be undone by the very systems they rely on. If you've enjoyed this deep dive into the world of hedge funds, make sure to like, comment, and subscribe for more content. Let me know in the comments what other topics you'd like me to cover, and stay tuned for the next video. Thanks for watching.